Hello everyone, Chad Frantzen here with Authentic Counsel, and in today's video I'm going to be providing a summary of the financial markets and the global economy. This particular presentation is specifically designed through the month of May as of June 1st, and it's really for our clients that we work with as well as prospective clients that we visit with. So this is our June 1st for the month of May capital markets review. And thanks for taking a few minutes to watch this. I think it'll help answer questions you have and just clarify our thoughts on kind of the markets and your investment accounts. So with that, I'm going to share my screen and we're going to get started in going through this. So one of the things that we've noticed, the markets have come back dramatically since March and April, and are back near all-time highs, surprisingly, even in light of current unrest in our country, as well as the impacts of COVID and the economy slowly reopening. So we're going to go through a few slides today. Again, these are our disclosure slides. Again, past performance not a guarantee of future results. And investment advisory services are offered through Authentic Counsel, a registered investment advisor in the state of Texas. On that, here's a couple of quotes to get started from Rosenberg Research. David Rosenberg, who's a Canadian economist, highly respected. And I think this really summarizes one of our concerns is that, there's close to 40 million people that are now unemployed. And of those, it's possible that 10 million will be permanent job losses because the U.S. economy is service-based and there's a lot that's dependent upon consumer spending that we think will probably come back quite slowly. It's hard for us to fathom that the markets and that corporate profits can really go back to where they were projected to be, given that a lot of the middle class and middle income Americans, hardworking jobs, potentially are not going to come back the way they were. And we may see continued unemployment and underemployment for that matter. This chart provides a good investment framework. These are from our friends at Wealth Shield. And if we look at the market from a four-part framework, we see market sentiment, monetary policy, market valuations, and economic growth. And if it's on the red, that means it's very negative. If it's on the green, it means it's positive. So market sentiment is negative. Monetary policy, which is the role the Federal Reserve and the government plays in supporting capital markets, is very positive. In other words, the government through the Federal Reserve Bank is really pulling out all the stops to support the markets, for better or for worse, and to print money through legislation and through their actions. Market valuations as well as economic growth are both in the red as well. So generally on these, depending on where we are in the economic and investing cycle, right now 3 out of 4 pieces of this framework are in the negative. This chart here, provided by our friends at Hedgeye Research, just looks at the different market peaks going back to 1900. And what you'll see is that we're still very much at the top end of valuations. And we don't think that the economy with jobs and earnings and just stability in the workforce is going to come back with any quick fashion. So we do feel like, right now, if we look at the peaks going back, the March of 2000 peak and October of 2007, we do feel like we're at those very elevated levels, which are historically synonymous with extended downtrends in the markets. Another way to look at this in our charts is the S&P 500, which is the 500 largest U.S. companies, what their forward-looking price to earnings ratio are. And what you'll see on this chart goes back to the mid-1980s, And you'll see here that forward price to earnings ratio, which is a measure to tell us how expensive is it to buy a company. If you want to invest in Amazon or Disney or Coca-Cola, you pay a price for the stock based upon the company's earnings, and you get a number. And so the price to earnings ratio is the highest it's ever been, second only to 2000 and the dot-com bubble. So very rich valuations for companies that we believe are going to continue to face headwinds going forward and into 2021. There are different valuation methods that we look at. If you want to learn more about these, you can look these up, but price to sales ratio is one that's followed by Warren Buffett, and that is at a very high level. So we would say that the valuations are just significantly high, that the price of companies out there compared to their sales, that it's a very rich valuation. And generally, you know, it's the timing of when we invest in things and how long we want to own it. So these are all, this valuation dashboard just really tells us that, you know, no matter how you look at it, things are expensive when we look at investing in stocks right now. This chart here shows that roughly 50% of CFOs, chief financial officers, in a latest CNBC survey believe that the COVID pandemic will have a negative impact on their business. And another 39% said that it would be very negative. So we know that as companies begin to deal with the new reality, some companies will rise to the top. Certain companies that are adapting to technology, innovation, that are connected with healthcare, will see good opportunities for growth and expansion. And, you know, some companies will not. And so this is, if there was ever a time where you want to evaluate your portfolio to see, well, am I invested in the types of companies that are going to be sustainable, that are going to add to helping us restart the economy through technology and infrastructure, this would be the time on that. So we believe financials will continue to be difficult for companies to navigate. This chart here was as of June 1st, released by the Federal Reserve Bank of Atlanta, and what's expected is a negative 51% drawdown or contraction in the U.S. economy for the second quarter of 2020. So this is a significant number. I mean, we believe this is the low, the bottom, and it will slowly come back, but this does have a contraction of 40 to 50%, does have significant bearing on how the economy works, how it reopens, consumer spending, how quickly people begin to travel and go to restaurants and movies and buy cars, and how quickly jobs are offered by companies as well. So this is a significant drawdown. This would be a depression level drawdown in the economy that we believe will really move from a depression to a recession in the coming quarter. Another quote here is by Jeremy Grantham of GMO, a very widely respected research and investment firm in the United States. And this quote I ran across this week, and I think this really summarizes it succinctly for where we are, is that price to earnings ratio for stocks is now in the top 10% historically. But the U.S. economy is in the worst 10%, or maybe the worst it's ever been. And so it really is, as he says, a mismatch. We would say that the stock market is divorced from reality. There is a lot of unrest in our country with obviously what's happening in the protest and the justice system, and then certainly the impact of COVID-19 and in the impact that it's having on families and companies. So never before have we seen, you know, the markets be at such high levels with there's so much uncertainty in the world. Now, we do believe that over time that the economy is going to recover. We're going to see new companies started. We're going to see a lot of innovation and technology. and advances in healthcare and even how we operate businesses. But clearly, this is a very opposing stat that is one to be aware of. With that in mind, this is a 7-year asset class real return forecast for the markets. One of the things we believe in is that we do believe active portfolio management is the best way to invest your money, whether it's in a retirement account or a brokerage account or through your company's retirement plan. Over the next 10 years, if you just buy and hold, most of the predominant asset classes in the world, be it U.S. stocks, be it international stocks, be it emerging stocks, we don't see, this is the next 7 years forecast, we would expect, really only emerging value companies to have a greater than average rate of return on that. So that means we have to be adaptable to how do we rebalance, how do we actively reposition assets into different things besides just buying and holding stocks for that. In closing, these last 2 slides are just really bringing together, that was just a fast run through some of the charts and commentary that we've been following in the last month that we want to bring you up to speed on. Obviously, we work with our research teams across the country to put together diversified portfolios for your investor accounts. Summary and playbook. Really, if you said, well, great, those are charts, I don't necessarily understand them, or that seems complicated or it seems ominous, let me try and summarize this. At Authentic Counsel, our diversified investment models remain defensive. We are keeping allocations to cash, gold, and government bonds as a way to protect capital. We do expect inflation to start growing in the coming quarter as the economy reopens and starts to get back going. We also do expect a significant market correction that would come back to really the global and economic reality that the stats that we've presented here show. So with that in mind, we are staying diversified and defensive. We do expect a market correction, at least on the order of 10%. Could be more, but again, we don't have the crystal ball, but we would expect that just based on the data that's coming out. Different types of investments that we are positive on include alternative investments such as private real estate or private debt, as well as individual equity exposure in certain sectors of the economy, technology, which I mentioned earlier, healthcare, biotechnology, and also rising dividend stocks. And we would include in there also companies that are on the edge of innovation, would kind of go into technology, but can be in other sectors as well. Another thought is guaranteed investment products. If you have annuities in your portfolio, obviously they're there for times like this where you have part of your money diversified into something that has a guaranteed rate of return or a guarantee of principal protection. And the annuities have held up quite well. And so they're doing what they're designed to do, which is to protect capital during volatile times. So if you have annuities in your portfolio, that should give you some sense of comfort to know that part of your portfolio is protected against what we've seen happen in the last few months, but also for continued volatility in the markets. Second page on our summary and playbook, we do believe current market valuations are at extreme levels, that they're divorced from reality, as we showed in the chart. And we do expect continued market volatility throughout the summer and into the elections of November. Finally, 3 thoughts for you as far as what you can be doing on your part. It's a good time to revisit what your comfort level is with your investment allocation. We often describe this as a speed limit of how fast you're driving. And the lower your score from 0 to 100, then the more conservative you want to be with your investment portfolio. Typically, we manage models from conservative to moderate to aggressive. And so if you have questions about kind of where you are on a risk score from 0 to 100, feel free to reach out to us. Our team can help educate you on where you are on that. And if you feel like you want to be more aggressive or more conservative, that's a better fit with you, this is a great time to be revisiting that. Second, for those of you clients who take out money from your portfolio, the ideal withdrawal rate based on the Board for Financial Planning is 3 to 5% annually. So if you have $100,000, ideally taking out $3,000 to $5,000 per year would be suitable from a long-term perspective. So if you're taking money out of a retirement account as part of a paycheck for your household expenses, it's a good idea just to revisit that and make sure that in times like this when we have volatile markets, it's helpful to make sure that your withdrawal rates are not higher than 5% per year. Some clients take those out at higher rates, and when the markets are going up, everything smells like roses. But when the markets are flat to going down, you can potentially see your account statements go down in value because the market returns are not keeping up with how much you're taking out of your portfolio. So if you have individual questions on that, we're happy to answer it. And then finally, we encourage clients to evaluate your savings and contribution rates to your investment accounts. If you're currently working, we recommend continuing to increase contributions to your 401k or 403b or IRA accounts. And if you're not working, either way, across the board, cash is king. So we really encourage the people we visit with, make sure you have, 3 to 4 months savings to cover you in your monthly household expenses. Ideally 6 months, but at minimum, you really want to have 3 to 4 months just in cash to where you can get to it if you have an emergency or if you have a job change or reduction in your employment on that. So those are just some key takeaways. Again, we want to thank you for your time. You can visit us at AuthenticCounsel.com. This is Chad Frantzen, Certified Financial Planner. And that is our brief monthly market review for the month of May, going over the capital markets and then also some specifics on our portfolios. We appreciate you watching. And if you do have questions, please feel free to reach out to our team and be safe out there. We thank you for the opportunity to work with you, and feel free to reach out to us at AuthenticCounsel.com. Take care.